Hello, my name is Adrian Houston. I'm a tax consultant and I used to be a tax inspector. And today I'm going to talk to you about the new dividend tax regime that British people are going to face from the tax year 2016-17. Now, if you only receive a small amount of dividends, you don't need to worry, and in fact you can stop viewing now if you want to. But if you run your own company and take your money out of that by way of a combination of salary and dividends, you really need to keep watching. And equally, if you receive a lot of dividends from your various investments, this is also the video for you. So what is changing and why has the Chancellor George Osborne decided to change it? The thing that's changing is that it used to be that if you received dividends and your total income was below the higher rate threshold, think in terms of sort of 42,000, 43,000, then there would be no extra tax payable by you. This allowed people to set up limited companies when they were for their business, and through that they could take a small salary and then quite a large dividend. And by doing that, they kept the overall tax bill that the company and they personally paid. The main saving they made was actually in national insurance, and George Osborne has decided to tackle this because he thinks it's unfair that people who are self-employed could decide to set up instead as a limited company and pay a lot less in taxes and national insurance. So, what are the changes that are coming in from the 6th of April 2016? The change is that from now on, you will have what's called a dividend allowance. In other words, you can earn up to £5,000 per year in dividends and you'll pay no tax on them. So for people earning under £5,000, this may mean no change. It may indeed mean less tax if they used to be a higher rate, if they are a higher rate taxpayer. But for people who receive a salary and dividends from their company, and the dividends are over the 5,000, this could mean you paying a lot more tax, maybe £1,000, £2,000, £3,000 a year. There's limited scope for you to do things about that, but you need to be aware of it and plan accordingly. So what are the tax rates? Well, first of all, let me remind you that the first £5,000 of dividend income is tax-free. And that applies whether you're a basic rate taxpayer, higher rate, or the maximum rate top rate taxpayer. But then once you've got that, what's in excess of the £5,000 is now going to be taxable. If your total income is within the limit for the basic rate of tax, £43,000 in 2016-17, then the dividend in excess of £5,000 will be taxed at 7.5%. 7.5%. Now, if your dividends plus your salary plus your other income push you above the basic rate threshold of £43,000, then you're into higher rate tax. Now, in the dividend scenario, that means that the dividends over the 5,000 could be taxed at 32.5%. The only people who will pay a higher amount of tax on their dividends are those lucky enough to be earning over £150,000 a year, and they'll be paying 38.1%. So how do you tell the tax office about this dividend income you've got? Well, there are two ways. First off, if you're running your own business as a limited company, you should already be filing an annual tax return. And for you, it's quite simple. You will put your dividends down in the tax return, as you always have done, along with your salary and any other income. If you are not normally filing a tax return, then you may have to file one from now on, and I would suggest that you write to HMRC and tell them your expected level of dividends. And then they can decide, do they want a tax return from you each year, or maybe will they make an adjustment to your tax code. In any event, you need to keep an eye on things so that you don't pay too much tax. For example, if the revenue adjusted your tax code for the estimated tax on your dividends, and then you earned less than you had estimated, the revenue may owe you some money back. So you may need to write them a letter once a year and say, for the tax year 2016-17, my dividend were £5,722. And then they can adjust the tax accordingly. So if you're thinking of setting up in business and don't know whether to do it as a limited company, then this new change means that it's a much more difficult decision as to whether to go for a limited company, which brings certain benefits but some additional admin and accountancy costs, or whether simply go for sole trader status or a partnership or a limited liability partnership. And for all of those, you may need to talk to someone like myself, a tax consultant or accountant, I'm both, who can talk you through the options and the relative costs, both in terms of accountancy costs and costs of money paid to HMRC in tax, national insurance, corporation tax, etc. If you are not in business but you do receive dividends over £5,000, you may want to also think about your options there. You might be able, for example, maybe over a period of a couple of years, to switch your shares from your name into an ISA. And if you do that, those that are in the ISA will not result in you paying income tax on them. But be careful, because you don't want to get hit with a capital gains bill. Capital gains tax affects you if you make a profit on selling shares, and will be particularly an issue if you've made more than about £11,000 of a profit. So it may be something you can do in 1 year, or you may phase it in over a couple of years and gradually reduce your dividend tax over the next few years. So if you'd like to have a chat with me, we can either talk about you coming to our business, our practice as a business client, or we can simply do a chat, a conversation either over the phone or in person, and for that we would charge an hourly rate. And hopefully we can then put your mind at rest and make sure that you can know what's ahead and plan for your tax bills accordingly. Thank you very much for listening. Bye-bye.